All right, let's get right into a complete exam revision for service costing. In just the next few minutes, we're going to break down every key concept, every formula, and every single exam trap you need to know to absolutely master this chapter. Okay, let's just jump straight into a classic problem. You're sitting in the exam hall and you get a transport costing question. It's asking for the cost per ton kilometer. Now, you know there are two ways to calculate this, absolute and commercial. They give you two different answers. Which one is right? This is a classic trap where so many students lose marks, and by the end of this session, you're going to know exactly how to handle it. I mean, think about it. You've got the same journey data. You make one calculation choice, you get one answer. You make another choice, you get a totally different answer. Now, in the real world, maybe it's a small difference, but in that exam hall, that difference is everything. It's the difference between full marks and zero. So, what's the secret? Well, let's build up the knowledge to answer that question perfectly. So to really get a grip on that problem, we have to start with the basics. First up, in section 1, we need to understand what makes costing a service so different from costing a physical product, something you can actually hold. So what is service costing, really? You'll hear it called operating costing, too. They're the exact same thing. It's just the method we use to figure out the cost of providing a service. And this works in two main scenarios. It can be for internal services, like a company's own staff canteen, or it can be for external services sold to customers. Think transport companies, hotels, hospitals, you name it. The logic is the same. You collect all the costs for a period, and then you divide them by a unit of service to get that all-important cost per unit. Now, here's where it gets interesting. Let's break down those differences. First, tangibility. You can't touch a service, right? And you can't store it. This is a huge deal because it means service businesses don't have finished goods inventory. Next, the cost units are often way more complex. We'll get into that. Then there's cost composition. With products, material is often the biggest chunk of the cost. But in services, it's almost always people, employee costs. And finally, tracing costs. It's just so much harder to trace overheads to one bus trip compared to, say, one chair. Getting these differences is key to getting the costing right. And that brings us to the most critical, calculation-heavy part of any service costing problem: choosing and, more importantly, correctly calculating the cost unit. This is where the real exam action happens, and where the marks are made or lost. As you can see here, every industry has its own unique cost unit. For a transport company moving people, we use passenger kilometers. If it's moving goods, we use ton kilometers. For a hospital, it might be patient days or maybe cost per operation. A hotel, they use room days. The key takeaway here is that the unit has to be a genuine measure of the service that's actually being delivered. But sometimes one unit just isn't enough. I mean, saying you transported a ton of goods doesn't mean anything unless you know how far you transported it. And that's where we get the composite cost unit. It mashes two measures together. And the classic example, the one you know you're going to see, is the ton kilometer. And this brings us right back to that exam trap we talked about at the very beginning, because there are two ways to calculate it: absolute and commercial. Okay, let's break down method 1. This is the absolute ton kilometer, or the weighted average method. Now, you've got to pay really close attention here. This is super important. In this lorry example, it's carrying different weights over different distances in one trip. The absolute method means we calculate the ton kilometers for each individual leg of that journey separately. And only then do we add them all up. It's a very precise, step-by-step calculation. And when we follow that precise method for our example journey, what do we get? The answer is exactly 5,600 metric ton kilometers. Just keep that number in your head for a second. Okay, now for the other way. Method 2, the commercial ton kilometer, or the simple average method. This one takes a totally different approach. Instead of looking at each leg, it just simplifies everything. It takes the total distance of the whole trip and multiplies it by the simple average weight carried across the whole journey. It's a much broader, less detailed calculation. And boom, here it is. This is the trap. Using the commercial method, we get 5,760 empty kilometer, a totally different answer. So here's the rule you have to write down and remember for the exam. Listen closely. Unless the question specifically says commercial or simple average, you always use the absolute or weighted average method. ICAI considers it more accurate. This is exactly how they try to trick you, and it's where so many marks are lost for no reason. Now, what happens if you're a business that offers different levels of the same service? So think about a hotel. They have standard rooms, deluxe rooms, and those fancy, luxurious suites. They all share the same building, the same staff, but they bring in different amounts of money. How do you cost them fairly? Well, that's where this really clever idea of an equivalent cost unit comes in. We find a common base to measure everything against. Let's look at how it works with this hotel example. We can decide that our base unit is a standard room. Then we just convert everything else into that. So if a deluxe room rents for 2.5 times a standard and a luxurious room is 5 times, we can restate all our occupied room days as equivalent standard room days. As you can see in the calculation, this gives us one single consistent base, 135,000 equivalent units, that we can divide our total costs by. It's a fantastic way to handle those different service levels. Okay, so calculating the cost is one thing, but how does a service business even know if it's doing well? For that, we need to talk about key performance indicators, or as you know them, KPIs. For every service industry, there are these specific numbers that really matter. In transport, for example, you'd look at truck turnaround rate. How fast can you unload, reload, and get that truck back on the road? For hotels, the big one is always occupancy rate. If you have 100 rooms and only 70 are booked, your occupancy is 70%. That number directly tells you if you're covering your huge fixed costs. And it's the same for hospitals, where bed occupancy rate is a vital sign of how efficiently they're running. And this same idea applies everywhere. For an IT company, they're watching the churn rate, how many customers are leaving them each month. In telecom, it's all about ARPU, the average revenue per user. For a college, the student-to-faculty ratio is a huge deal for quality and costs. And for an insurance company, you better believe they are watching the average cost per claim like a hawk. So, we've figured out our units. We know how to measure our performance. Now for the final piece of the puzzle. How do we put all of this together into the final operating cost statement that the examiner actually wants to see? The structure is pretty straightforward. You're just going to sort all your costs into a few buckets. First, you've got your fixed costs, sometimes called standing charges. These are things like rent or insurance that don't change with activity. Second, you have your variable costs, or operating expenses, things like fuel for a bus, that change directly with how much service you provide. And third, you have semi-variable or maintenance expenses. And here's a quick pro tip. If the exam question doesn't give you enough detail to split the semi-variable costs, just stick to fixed and variable. Simple. And here we go, another huge exam tip. You will see this. Depreciation. It's on the list of costs, but where do you put it? Is it fixed? Is it variable? Getting this one wrong can mess up your entire answer. So what is it? Here is the golden rule. You have to remember this. How you classify depreciation depends completely on how it's calculated. If it's based on time, like the straight line method over 10 years, then it's a fixed cost, simple. But if it's based on usage, like per kilometer driven for a truck, then it becomes a variable cost. You must read the question carefully to see how they've calculated it before you classify it. Imagine you see this in your exam paper. Running charges, 2,94,400. Now, your first instinct is probably to just grab that number and plug it straight into your cost sheet, right? But wait, look closer. See that little note in the brackets? Includes 12,400 paid as penalty for overloading? That's the trap. That one little line is where the marks are won or lost. So what's the right move here? Okay, first things first. You have to get this one concept straight in your head. Service costing, or operating costing as it's also called, has one main goal: to find the normal cost of providing a service. The key word here is normal. This means that anything, and I mean anything, that's considered an abnormal cost, something outside the usual day-to-day running of the business, has got to go. It has no place in our operating cost sheet. And that brings us right back to our little problem from the start. A penalty for overloading? Is that a normal cost of running a truck? Absolutely not. You're not supposed to break the law. So it's an abnormal cost. And here's the rule you have to remember. You must exclude it. You take that 12,400 and subtract it from the running charges. It doesn't belong there. Instead, it gets debited to the costing P&L account. Guys, I can't stress this enough. This is a classic ICAI exam trap. So many students lose marks on this exact point. All right, now that we've nailed that common trap, let's dive into the big one, transport costing. This is probably the most frequently tested area in service costing. We're talking buses, trucks, you name it. The basic ideas are the same across the board, but you've really got to pay attention to the specific cost units and how the costs are structured. So the very first thing you do is figure out what's being transported. Is it goods or is it people? Because that determines your cost unit. If you're moving goods, your unit is the ton kilometer. If you're moving people, it's the passenger kilometer. See how it's got two parts? That's why it's called a composite unit. It's not just about how far you went,
It's about how far you went while carrying something. That's the actual service.
Okay, next up, you need to take all the costs and sort them into 3 main buckets. First, you've got your standing or fixed costs. Think of things like insurance, road tax, garage rent. These are costs you have to pay even if the truck doesn't move an inch. Second, you have running or variable costs. This is the obvious stuff, like petrol, diesel, oil, costs that go up the more you drive. And then there's a third bucket in the middle, maintenance or semi-variable costs. This is for things like repairs and tires. Now here's a classic ICAI twist you need to watch out for. Take a driver's salary. If he's paid a fixed amount per month, it's a standing cost. But what if the question says he's paid per kilometer? Boom, it suddenly becomes a running cost. So you absolutely have to read the question carefully every single time.
All right, let's talk about a math problem that catches so many people out. It's the commission on takings trap. The question might say something like, the driver gets a commission of 10% of total takings. The problem is your total takings depend on your total cost, but your total cost includes the commission. It's like a chicken and egg situation. You can't just guess. The only way to crack this is with a bit of simple algebra. Don't panic, it's easy. Just let total takings equal x. Then you build your equation. X equals your fixed and variable costs, plus the commission, which is, say, 0.10 times x, plus your profit, which might also be a percentage of x, say 0.15x. So you get something like x equals 21,30,000 plus 0.10x plus 0.15x. From there, it's just basic maths to solve for x. Easy marks if you know the method.
Now, when it comes to calculating those ton kilometers, there are actually 2 different ways to do it, and you need to know both. There's absolute ton kilometers and commercial ton kilometers. Think of absolute as the super precise, detailed method. You calculate the ton kilometers for every single part of the trip. So from city A to B, you do distance times weight. Then from city B to C, you do that distance times the new weight, and then you add it all up. Commercial is the simpler, quicker way. You just take the total distance of the whole trip and multiply it by the average weight carried. The exam question will almost always tell you which method to use, so just follow instructions.
Okay, and this brings us right back to that penalty for overloading. This is a massive ICAI twist, so please pay close attention. We've established that the penalty amount, the money paid, is an abnormal cost, so you exclude it from your costs. Got it? But, and this is a huge but, when you calculate your ton kilometers, you must include the overloaded weight. Why? Because the truck actually did the work. It carried that extra weight. The service was provided for the total weight. So let me say it again. Penalty amount is out of the cost. Overloaded weight is in for the ton kilometer calculation. If you remember this one rule, you're already ahead of the curve.
Awesome. We've covered a ton on transport. Now let's switch gears a bit and move from roads to rooms. We're talking about hotels and hospitals now. The basic logic of service costing is exactly the same, but you guessed it, they come with their own unique cost units and their own set of challenges. So with a hotel, you have a problem. You've got single rooms, double rooms, luxury suites, plus you've got a peak season where you're full and an off season where you're half empty. How on earth do you find a single fair cost per room? The answer is a clever little concept called equivalent room days. What you do is convert everything into one standard unit. For instance, if a double room is treated as being worth 1.5 single rooms, you do that conversion. Or if the off-season has 50% occupancy, you can treat 2 off-season days as being equivalent to 1 full occupancy day. It's all about creating a common denominator so you can allocate your costs fairly.
And if you think hotels are complex, hospitals are on another level. A hospital isn't just one service. It's like a mall full of different service businesses all under one roof. You've got the outpatient department, the inpatient wards, the x-ray lab, the laundry, the cafeteria. You can't just have one single cost unit for the whole hospital. It wouldn't make any sense. So you have to break it down. You find the cost per outpatient for the OPD, the cost per patient day for the wards, the cost per scan for the radiology department, and so on. Each department gets its own relevant cost unit.
Okay, let's bring this into the 21st century. How does all this costing stuff apply to, say, a software company or a big bank? You might think it's totally different, but actually the fundamental logic is exactly the same. You just have to identify what the service is, what the costs are, and what the right cost unit should be.
In the IT world, what's the main raw material? It's not steel or plastic. It's people's time and brain power. Right? So the most fundamental cost in any IT project is what we call effort cost. It's really just a fancy term for the cost of an employee's time on a project. You'll calculate it as the cost per person day or maybe per person month. This is the single biggest cost driver for any software project. And just like in a factory, You have to separate your direct costs from your overheads. So if you buy a special software license just for Project Alpha, that's a direct cost to Project Alpha. If you fly an engineer to the client site for that project, that's a direct travel cost. But what about the cost of general Java training for all your developers, or the HR department's salaries? Those benefit everyone, so there's service overheads. And just like with factory overheads, you have to find a fair way to absorb or apportion them across all your projects. And what do you get at the end of all this? Well, for something like a bank, you can get a really precise number. You figure out the salaries of the people who work on home loans, you add in a fair share of all the bank's overheads, the rent, the admin staff, the IT systems, and you can calculate the exact cost to process one single home loan application. In this case, 570 rupees and 50 paise. That's the power of service costing. All right, let's zoom out now and think really big. I'm talking massive infrastructure services, like a power plant or a 6-lane toll highway. The scale is completely different, but believe it or not, the costing rules we've been talking about still apply. For a powerhouse that's generating electricity, for example, you'd use a composite unit like cost per kilowatt hour to figure out your cost. And for those huge highway projects built on the BOT, or Build, Operate, Transfer model, costing isn't just important, it's everything. A private company builds the road, and they get to operate it and collect tolls for, say, 20 or 30 years. They have to calculate every single cost over that entire period, construction, interest, repairs, everything, to figure out the exact toll they need to charge to make their money back and turn a profit. It's a massive costing exercise. Phew, okay, that was a lot. We've covered a huge amount of ground. Before we finish up, I want to do a super fast recap of 2 key theoretical terms. These are the foundations of the whole chapter, and knowing the definitions can be a really easy way to pick up some marks. First up, the composite cost unit. We've been talking about this the whole time. It's just a cost unit that has 2 parts to it. It's not just per ton or per day. It's per ton kilometer, per passenger kilometer, per patient day. It combines a quantity with a service element to give you a much richer, more meaningful cost unit. And the second one is the equivalent service unit. Just think back to our hotel example. You had single rooms and double rooms, peak season and off season. They're all different, but they use the same building, the same staff. An equivalent unit is just a way to convert them all into a standard, comparable unit so you can allocate costs fairly. That's all it is.